The November Purchasing Managers Index picked up some momentum in November, rising by 1.1 index points to 51.6. The PMI beat local consensus expectations of a decline below 50 and also backed that international trend of weaker PMI data. Abdul Davids, head of research at Kagiso Asset Management, joins us now to unpack the numbers that have come to the fore. Thanks so much, Abdul, for joining us this afternoon. Well, as I say, we've seen somewhat of a ticking higher in November. We had the index rising by 1.1 index points. Probably more significant, though, is that this is the fourth consecutive month of gains for the PMI. Just how optimistic are you right now about where we're headed?
Yes, thank you very much. Yes, I think what we have seen is that the momentum and the recovery momentum that we've seen since the July low has been maintained for the fourth consecutive month, as you've said. Unfortunately, a lot of what we have seen in the recent numbers, the October number that has shown a recovery on September and now the November number, is really just a recovery from that very low of July, which was typically impacted, as we know, with the strikes, the stoppages, etc. Unfortunately, we are seeing the backdrop of especially the woes in Europe, the economic growth scenarios and concerns in Europe starting to impact. And one of the numbers that we look at is the expected business conditions index, which has declined by over 7 points. Now, that is an indicator that future PMI numbers might be under pressure, especially the December and January numbers as well. And
possibly, setting the tone for that, I mean, the inventory index was the biggest gainer to reach 54.4 points, suggesting that purchasing managers expected demand to be somewhat stronger than it actually turned out to be, Abdul, because they purchased inputs in anticipation of increased demand, which didn't necessarily materialize. So now we see that tempering of expectations possibly on the back of that data point?
That's correct. Also, if you look at what we call the leading indicator, which is typically the ratio of new sales orders to that inventory number that you mentioned, that is starting to weaken. The October number was over 1. We are now back below 1 at about 0.94. Now, that's typically an indicator that purchasing managers are a bit wary about the expected business conditions. They are starting to temper the new sales orders numbers, and as a result, the leading indicator is starting to soften as well.
To what extent do you see that impacting pricing power moving forward? Because this time round, prices have held pretty steady at 82.1 and it seems to be plateauing.
Yes, a lot of the pricing index is driven by what the currency does, unfortunately or fortunately. A lot of the sub-indices in terms of the price index itself relies on imported prices. We know that the currency has weakened substantially over the last 3 months in particular. And that unfortunately has meant that at about 82, the price index has plateaued at a fairly high level. Now, in a scenario where the rand starts to strengthen again, presumably below 8 or even 7.50, we should see downward pressure on that price index coming through as well.
Oh, let's get your perspective on the rand, Abdul, because we've got a question of the week for our viewers out there, asking them where they see the rand headed for the rest of this year and possibly into 2012. We've had, ranges from 820 to 920 having been given. What's your perspective on where the rand's headed as we close this year out?
Yeah, I think we are notoriously bad at forecasting the rand, so I'd hesitate to take a guess at where the rand is going to stabilize at. But I think from our manufacturing sector point of view, a weaker rand is typically beneficial to them. If you look at the traditional income statements, the revenue line is obviously a significant focus of that is exports. With a weaker rand, that is positively impact on the export sector as well. Clearly, the offset against that is imports, where a weaker rand is increasing the cost of imports as well. But we think that for the manufacturing sector in South Africa, anything above 750, I think what we have seen over the last couple of years, the manufacturing sector in South Africa has rebased the cost structures to cope with a rand of about 750. Anything above that, I think, would be beneficial, and obviously the cherry on the top as well.
Well, talking about cherry on the top, let's take a look at a more positive side of this, these numbers that have been released today. The business activity index rose by 1.4 points, and also, that's suggesting that we're seeing improved actual factory output in the final 3 months of the year. It seems to have translated to the employment number as well, with employment rising from 45.6 to 46.5. It has been marginal, but at least some upward momentum taking hold there.
Yes, that is correct. Also, what we are seeing is that a lot of the activity in terms of the business activity, that is typically what we call a coincident indicator. So it's what is happening right now in terms of our manufacturing sector. Unfortunately or fortunately, a lot of that we can probably attribute to the rand as well, where we have seen two things happening. First of all, the export market is starting to liven up again as a result of the weaker rand, but also we think that imports have started to dry up. Given that the rand is weaker, imports are becoming a lot less competitive compared to locally manufactured goods, and as a result, even though we still have significant excess capacity in terms of employment, and that number is still significantly below 50, the improvement in that number, about a 0.9 index points increase, is a positive indicator for the future as well.